Everyone knows that diversification is a good thing for your portfolio. But do you know how it works? Do you know why it works beyond not putting all of your eggs in one basket? Let me back up. I think it's pretty safe to say that the financial markets are pretty noisy. They bounce all over the place. And while there's some signal, some piece of the returns that are meaningful, a really big chunk of a stock's return is just noise that doesn't really matter, especially in the short term. And that's where diversification, which is sort of just a fancy way of saying owning a whole bunch of stuff in your portfolio, comes in. And I really am serious about diversification really just being owning a whole bunch of stuff. Because the whole idea is that owning all of these different things, all of these different stocks that are all bouncing around semi-randomly, will mean that the random part of that return, the noise, will cancel itself out. This means that you're left with the non-random part of the return, the meaningful part of the return. That's the whole reason we invest in the financial markets in the first place. If you want to dive into understanding why this non-diversifiable risk is so important and useful for investing, take a look at our article, Taking the Risks That Make Sense. I've got the link down in the description below. But for now, let's take it as a given that there are risks in the market that we want to take on. Otherwise, what's the point of investing? Effectively, diversification clears the board and allows us to focus on those good risks that we actually want in our portfolio. But I want to call out a common misconception. Having a diversified portfolio does not mean that you've gotten rid of all of the risk and that your portfolio can't go down. We've just been talking about how it lets us focus on the risks that matter. What it does is clears out all of the junk. It substantially reduces all of the unhelpful risks that you would get from investing in a single company or a small group of companies. So how does it do this? Well, let's look at an example. We'll start simple with a single stock. And just to be clear, this is an example I've created out of whole cloth. Nothing we're about to look at are real returns. But let's start with that single stock. And we'll assume that we know that the stock has an expected annual average return of 10%, a standard deviation of 30%. And let's say we look at the stock over the next 30 years. If we plot out the return, it'll look something like this. When all is said and done, this stock had a pretty darn good 30-year period and came up with an average return of almost 11% and a standard deviation of about 27%. Essentially, we got lucky with a good return and a little bit less bumpy of a ride than we would have expected otherwise. But what if we had a portfolio of 10 stocks, including that one that we just looked at, over those same 30 years? Well, it's actually a little bit of a mixed bag. The average return, just by chance, was a little bit lower across the portfolio, but you can already see just how much less bumpy the chart is. We reduced our standard deviation from 27% for the single stock all the way down to a little less than 9% for the portfolio. And we'll come back to the effects of that slightly lower average return in a minute. But we can do better. What if we had 100 stocks rather than 10? Well, as you can see, the line gets even less bumpy than before. And now the portfolio standard deviation is 2.5%. Now, I don't want to belabor this. I think you kind of get the joke at this point. But what happens with 1,000 stocks? Well, this, an all but straight line. In fact, the portfolio standard deviation is 0.9% per year. And it's important to recognize that this isn't just valuable for reducing how bumpy of a ride your investments are taking you on. Lower volatility, all else being equal, means higher total returns. This is because returns aren't symmetric. For instance, Let's say your portfolio loses half of its value in a year. It goes down by 50%. Hopefully, this never happens, but if it does, getting a 50% return the next year won't make you whole again. To get all the way back to where you were, you would need to double your money. So instead of just looking at the year-by-year returns, let's say we invested $100 in each of these portfolios at the start of those 30 years. What would it look like at the end? As we can see, there's a really big difference. Remember how I said that the average return of the single stock was pretty good and the average return of the 10 stock portfolio was a little bit lower? Well, to put some numbers around this, the single stock had an average return of 10.9% per year, and the 10 stock portfolio had an average return of 9.8% per year. Over those 30 years, that 1% difference is a big deal. But look at what happens when we factor in the volatility. That volatility reduction is massively important. We went from an ending value of $853 for a single stock all the way up to $1,500 for the 10 stock portfolio, even with that lower return, just by reducing the noise in the portfolio. And the 100 and 1,000 stock portfolios, they did even better. This is why diversification is so important. It may reduce the chances of you betting it all on the next Apple, but it increases the chances of you having an overall good investing experience. I know which one I want to focus on in my retirement plan. Now, this is a stylized example. Since these are all just random returns based on a distribution, all of the stocks are completely uncorrelated with each other. How one moves has no impact on how the others move. So we're going to see some pretty drastic effects, even with the smaller portfolios, like the 10 stock portfolio, in terms of the effects of diversification. But the principle is the same. As you add in more and more different securities, which aren't going to move exactly like each other, those differences will keep chipping away at the random noise in the markets, exposing the risks that we actually want to be building our investments around. And this is why diversification is such a good thing for your portfolio and your retirement. It's pretty much the only free lunch in investing. Normally, to get higher returns, you have to take on more risk. Or if you want lower risk, you have to accept lower returns. Diversification is pretty much the only thing that you can be doing that can improve your overall returns and reduce your portfolio risk at the same time. It's not a magic wand, though. Nothing in retirement planning is. If the markets as a whole drop, your portfolio is going to drop right along with it. But that market risk is the whole point of investing. It's the reason that you don't just keep your money in a savings account. And if you want to find out more about why that is, and what else you can be doing with your investment portfolio to help you reach the retirement that you want, you should take a look at our free ebook, The 9 Principles of Intelligent Investors. You can download it for free by going to retirementresearcher.com/principles. It's here on screen. And we've also got it linked down in the description below. This will help you take this framework for how the markets work and understand what to do with that in a practical sense and what that means for your investment portfolio. If this was helpful, be sure to like this video and subscribe to our channel so you can see what we're up to. If you have any questions on this or any other questions that you'd like me to address, just drop them in the comments below. You can also check us out on the web at retirementresearcher.com and make sure to sign up for our weekly newsletter to keep up to date on everything that we have going on.